This is on regulation of digital assets and in particular security tokens and marketplaces. The key themes that you need to remember when going through this is that essentially a blockchain is a database software. It's a smart contract, and a token is a line in the smart contract. A token can be a digital representation of an underlying asset, or it can be anything anything can be digitally represented.
And Emma, I think that's a super important point that we've talked about, you and I, a bunch over the last several years. This idea where the token is representing the asset. So you can have a token that represents a share of stock. You can have a token that represents a bond, but you can also have tokens that represent currencies or frequent flyer miles or Air Jordan shoes. And so one of the important themes, as we say here, is that just because it's blockchain, just because the technology wrapper is blockchain, doesn't mean that all of a sudden we've created securities. It also doesn't mean that all of a sudden we've created some new asset class that nobody's ever heard of or thought of before. And so it's really important to analyze the functions and features of the digital represented item or asset, not just focus on the technology.
Indeed. And
this point carries over in the next couple of slides. We're happy to share the slide deck with people. If you want to reach out to us on LinkedIn, we're happy to send you copies of the slide deck. And let's just pause on this one, the intangible assets, right? So we can sort of think of two different kinds of assets. We can think of tangible assets or physical assets and intangible assets. And physical assets is basically anything you can touch. Intangible assets is basically human ideas. And so how do we represent human ideas? Well, we represent human ideas in all different kinds of ways. Securities are a human idea. They're not a physical or tangible item. And so thinking about how to create security tokens, thinking about what security tokens are, that's sort of an important question. It's an easy question when the intangible asset is a share of stock. It's a more difficult question when it's an investment contract, and that's a sort of uniquely U.S. and Canadian idea. This concept of investment contract. I don't believe there's any other country in the world that has this same concept. There's lots of countries that have collective investment schemes or pooled asset schemes, but investment contract is a much broader idea, and one that I think, as many people know, in the US was established under the Howey test. And people are sort of struggling to interpret investment contracts based on the Howey test now. But we shouldn't forget that you can create these digital assets. You can create anything to be digital. And so shares of stock, there are lots of companies that are looking at how they can put stock on the blockchain or bonds on the blockchain. Europe has a whole DLT regime that they proposed last fall, and they're working through comments on. This is separate and apart from their market in crypto assets regulation. This is specifically about financial assets on blockchain and how blockchain can be used for custody, clearance, and settlement. Emma, just hit the from current slide. Go back to slideshow and go back to slideshow up at the top. At the top of the document, you see where it says slideshow? Click that and then click from current slide. Yeah, there you go. It's not working. Try to click from the beginning.
It has changed on mine though.
Oh. So you see it as a slideshow, but not everybody does.
Hi, Emma. It's Craig here. Can I help with anything?
We're just having some trouble presenting the slide in a slideshow format.
So if you click to play your slides, you know, in the bottom right corner of your screen below your slide, in your footer bar, you should see the play the PowerPoint presentation. Can you click that? You should see full screen.
On the actual present
on PowerPoint within PowerPoint.
Okay.
You know, when you normally play your slides to go full screen, it should click that. It should work fine. Not there at the bottom, but we can all see it, I think. Yeah, down there. There's usually do you see the play button? On mine, it's it looks like a little presentation stand, like a slideshow. Start the slideshow.
Yeah.
Yeah, she's clicking it, but it doesn't seem to be changing. Emma, are you using multiple screens?
Yes.
So maybe what's happening is you're sharing one screen, but you're seeing it. Oh,
Press
somebody
F5.
Press F5.
There's always a Watson in the group, right? Does that work? Lee, do you have the same deck? Did you want to try opening it up from your station?
Yeah, hold on, let me try.
But I see in the chat here, people can see the slides, even though it might be a little bit smaller. So I think, you know, we're good to go. We want to cover the content. But maybe, Lee, if you can give it one try, and then we'll go from there.
Okay, let me see what I can do. Bear with me. It's making me. I'm not going to be able to do it. It's because it's changing the settings in Google Chrome. It's going to force me to close and reopen.
Okay, I'll pull them back up again.
All right, sorry.
Dan had a good suggestion too. If you share your deck in chat, everybody can download it and just pop it up locally on their screen. That's another option.
Sure.
maybe you'll have the smaller one, and then they can toggle if there's a lot of detail on the slide.
How do you put a file in the chat?
If you can email me the file, I will upload it to our server, and then we can make it available.
Okay.
All right.
I'll do that now.
Yeah. Sorry, everybody. So Emma, while you're doing that, I'll do some more talking, and then hopefully we'll get this all sorted out. Sorry about that, folks. So what we were talking about was this idea of security tokens and what is a security token. Starting with traditional securities and how traditional securities can be digitally represented on blockchain. I think there's lots of different formats that people are experimenting with right now. I had mentioned what's going on in Europe. I know DTC here in the US is also working on things. I'm not sure what's happening in Canada, although I know that there's a whole bunch of different things that are happening from the Canadian regulators. So if anybody in the chat knows what's going on in Canada, we'd love to hear about that. Emma, why don't we go to your to that first security token slide, and you can start talking about some of the issues there from a US perspective.
So security tokens are essentially the same technology as all other tokens, but they're designed to be security and issued and marketed as such under Reg CF, Reg D, and or Reg S. These are usually issued on a private or public version of Ethereum utilizing the ERC20 or EC 1400 standard. Marketing materials, the security token is still, to all intents and purposes, subject to securities laws. So marketing materials, for example, need to meet the normal standards of good disclosure for private placements. The most common exemption for a security token private placement is Section 506C of Regulation D, which requires the issuer to verify that each and every investor is an accredited investor, as opposed to self-certifying. This is a heavy burden best handled by an automated platform.
And there's actually been a whole bunch of tokens that have relied on 506C in their offerings. Probably the most prominent token sale that started out relying on 506, but then ended somewhat disastrously was the Telegram situation. Telegram pre-sold tokens to accredited investors, raised over $1 billion from those accredited investors. But when the network was about to go live, the SEC sued Telegram for an injunction to stop the network going live and to stop the distribution of grams, which were the tokens that the Telegram blockchain was creating. The SEC said, well, that's an investment contract. The grams are an investment contract. And unfortunately for Telegram, they lost at the preliminary injunction hearing and basically abandoned the project from there. So we sort of see this mixed world where people are relying on 506C in Regulation D to do a private placement, sort of initially to purchasers. But then what you're getting is still the question from the SEC of whether or not your token is a security. There's also been a couple of Regulation A+ offerings in the U.S. Regulation A+ is a limited public offering. There's been two tokens that have been done under Regulation A+. One of those is Blockstream, which has taken the position now that their token is no longer a security. It's not clear whether the SEC agrees with that position or not. I personally find it sort of crazy that you can have something that is a security, and then somehow it becomes not a security. You know, when I think about investment contract, conceptually, I can understand that the investment contract would end, contracts end or terminate all the time. And then the subject, the items that were the subject of the investment contract are not part of a security, right? The investment contract no longer exists. But this idea that, you know, a token might be a security for a while, and then maybe it's not a security for a while, then maybe it becomes a security again in the future, that just seems impossible, I guess, unless tokens are similar to subatomic particles, or you know, just way too cumbersome, because you'll always be in a situation of not knowing whether or not you've done something that makes your token a security or not. Yep. I see in the chat, this is a really good point that a lot of people talk about in the US. And there's been actually a huge amount of debate over the last couple of years here in the US about whether or not the accredited investor standard is worth keeping, particularly on the basis that it keeps a lot of people from gaining wealth. This is actually a really interesting question, Emma. I don't know how you feel about this, but you know, what's your thinking in terms of whether or not there should be some dividing line, either a sophistication test or a net worth test or something like that, to allow people to invest in private placements? Or should we just abandon the distinction between private offerings and public offerings altogether and sort of come up with some new regulation that fits in the middle?
I think there should be some kind of protection. Private placements are a, you know, complicated and unsupervised by the SEC, so you don't have someone checking the standards of good disclosure and so on. But I think the new changes to the accredited investor test, particularly allowing people to take the Series 65, which is an unsponsored FINRA exam, is a good balance.
Yeah, I mean, it's a really interesting topic, and lots of people have been going back and forth on it. I sort of overall agree with you, right? If we were to get rid of the distinction between public offerings and private offerings, then I would be in favor of dragging the private off, you know, dragging that single regulation much closer to what you have with public companies, as opposed to what you have with private companies. You know, it seems to me that there's a lot of opportunity in the private space for shenanigans to happen. There's much less opportunity in the public space for shenanigans to happen, although of course public companies have trouble all the time and get sued all the time. So it's a really interesting question. There is actually one security token that's done a full public offering. That's the INX token. INX is an exchange player in the blockchain space, and they created the INX token, and it took, correct me if I'm wrong, Emma, 3 years for them to get through the SEC and get approved to do their public offering of the INX token, which, you know, by the way, the INX token is not part of the capital stack of INX. The INX token does entitle you to some modest revenue share on INX exchange, and that's really what sort of makes it a security, but it's not part of the capital stack in the traditional sense. And so it, I guess, posed some interesting issues for the SEC. I don't know, Emma, how closely did you follow that whole situation? Did you read some of that
Not
stuff?
particularly. It just, I find the Reg A Plus and the public offerings a bit pointless when there isn't a forum in which they can trade at the moment. So the whole point about having a security token is that liquidity, and all of the ATSs are all Reg D. So I don't pay a lot of attention to public offerings because they just don't seem to have a point.
Yeah, and I mean, that's a big problem in the US. And as you say, it really inhibits the ability to do a public offering of a token, which would seem in some ways to be a little self-defeating, because you should want people to want to do public offerings so that investors get the benefit of all of the disclosures that come along with public offerings, et cetera, et cetera. So from an investor protection standpoint, it would seem like the SEC might prefer as many public offerings of tokens as possible. But as you point out, Emma, it does create a whole bunch of knock-on issues, particularly around broker-dealers and exchanges and ATSs and custody, all of which sort of remain unresolved from a US law standpoint. I know in Canada it's been a little bit better. The Canadian regulators have started to do a little bit more, you know, with regard to explaining what's going on. And as I mentioned, in Europe, I think there's been a lot of progress made. The market in crypto assets regulation is undergoing revisions and commentary right now, and I think they expect to have it finalized this year. And the same thing with the DLT infrastructure regulation, which is also undergoing comment and refinement right now. So I expect that Europe's actually going to be quite a bit ahead of the US in terms of giving people understandable structures here, both on, but you know, sort of the quote unquote crypto asset side, that is to say, non-regulated financial instrument tokens, and on the tokenized financial instrument side, that is to say, instruments that are currently regulated financial instruments, just they're in token form rather than in some other digital or paper form. Shall we move to the next slide, Emma?
Sure.
I don't know if it moved on your screen, but it didn't change for everybody else.
Okay.
There we go.
Did that change?
Yes, we got it. So you want to talk a little bit about why use a security token?
Sure. Using a security token is an advantage when you've got complex capitalization tables. You have far better control over the table and compliance. Funds also looking to align interests with investors, particularly of liquid assets, likewise get better control. Both emerging companies and funds also benefit from the liquidity that token ATSs permit. These are few and far between, however, and so far the liquidity has been pretty bumpy. You're looking at a 3 to 5x spread, but that's still better than nothing. Security tokens also have a strong use case when you have a lot of paperwork. So with municipal bonds, where you can end up with several thousand holders, it's having something that's electronic rather than paper-based is an advantage.
Have any municipal securities been done on blockchain yet, Emma? Do you know?
No, unfortunately.
It does seem like a logical use case. I mean, when you look at the landscape in the U.S., sort of what do you see as the main blockers to moving all of this forward on the blockchain? Are
Custody and control. It's people want to be able to just deal with it as if it's a typical securities account, and the custody piece of it, unless you're on a private chain and you're handling the custody within the solution, it's just too big a hump for people to get over.
Yeah, and I know the SEC put out that statement on custody at the end of last year, and they published it in the Federal Register. I think it was back in February, where they created this sort of new class of broker-dealer that would only be able to keep custody of digital asset securities, as they call them. That was, I think, a fair idea of theirs, and I know there were a lot of comment letters. There have been a lot of comment letters so far trying to further understand what the SEC is doing there. You know, this idea of having to have a special kind of broker-dealer just to keep custody of, you know, tokenized securities, as opposed to the way custody is kept of lots of other types of securities. You know, it doesn't always make a lot of sense to people. Did you have some thoughts on that subject?
Yeah, I think it was a relatively backhanded move because so many broker-dealers have worked really hard with FINRA, as well as going through the first SEC digital asset examination. And the security token market is just so thin that you have to be able to do regular business, because otherwise, it's just not economically viable. So to require broker-dealers to have a special purpose broker-dealer for digital assets is just financially impossible. And as I've been saying to our friends at the SEC for a long time, if they keep on going the way they're going, they're going to put everyone out of business.
Yeah, and that's been, I think that's been a major complaint that a lot of people have had, is that between a lot of uncertainty about when a token is a security, and then a lot of uncertainty of even assuming a token is a security, you know, how do you deal with custody? What do broker-dealers do? What do investment advisors do? What do investment companies do? I think there's just a whole host of issues that remain sort of unsolved. And I think that's, you know, that's a long-term problem, or rather I should say, it's a problem with long-term consequences in the US, because it drives a lot of people to go elsewhere to do their activities, to conduct their activities. We know of a lot of tokens that get only outside the US. We know of a lot of exchanges outside the US that trade, you know, many hundreds of tokens, as opposed to most of the US exchanges, which, you know, they trade 25 or 30 different tokens at the most, and then it's the ones that they're, you know, fairly certain are not securities. Although obviously we had the Ripple situation when the SEC sued Ripple late last year. You know, we ended up with a situation where, a bunch of exchanges ended up with a situation where they had listed Ripple, but they were not either registered as an exchange or registered as a broker-dealer with an ATS. So they kind of got caught in this weird situation. And it's not clear what the SEC's stance is on any of that. So it'll be interesting to see what happens in the Ripple case, what the upshot of that is. We now have a bunch of slides that sort of talk in a little bit more detail about the SEC's jurisdiction and the relevance of the Howey test and other things. I don't know that it makes sense for us to go through, march through all of them one at a time on the SEC, but maybe, Emma, if we can jump to the CFTC slides. We haven't really covered the CFTC very much. I know we are putatively talking about security tokens, but maybe we should mention some of the CFTC stuff. Did we include the CFTC slides, or did we take them out?
I think I pulled them out.
We pulled them out. Well, maybe we'll talk about the CFTC stuff just a little bit, because that's the other big regulator in the US that has jurisdiction over tokens. And I think it's relatively well accepted right now that if a token is not a security, it is a commodity for US law purposes, and therefore falls under the jurisdiction of the Commodity Futures Trading Commission. That jurisdiction works in a sort of interesting way. Spot trading in commodities is not heavily regulated. It's basically just anti-fraud regulation. But futures and derivatives on commodities are heavily regulated. And so the question arose in the US is, when does it stop being spot trading and start being some kind of futures or derivatives trade? And the CFTC clarified this issue about 1.5 years ago in a rulemaking that people found somewhat controversial, because it required actual delivery of the blockchain tokens within 28 days, and that those same tokens could not be subject of margin trading. So it had to be full possession with no liens and no other claims on ownership or potential claims on ownership. So that sort of threw things into a little bit of a tough state for some of the exchanges in the US that wanted to offer margin trading, because they had trouble figuring out ways to collateralize the margin loans when you can't collateralize it with the actual tokens that are being purchased with the margin loan. So I don't know how all of the exchanges have solved that. I know Coinbase stopped doing margin trading, I think it was last fall, maybe late fall last year. And I assume, although I don't know for a fact, that that was in response to trying to understand how they could make that work in light of the CFTC's rules. Emma, any thoughts you want to share on the CFTC side of things?
No, I think you covered that nicely.
Okay. You want to talk about legal requirements for STO service providers?
Sure. To work on a security token, to design it, to advise on it, you have to be a FINRA registered rep, specifically a Series 79. In addition, it is still a relatively expensive process to do an STO, because it's still the preserve of international law firms, major tax and accountancy advisors, and that racks up the costs pretty quickly. A security token fees can run up as high as 500K. And then the issuance platforms have their own fees as well, which vary in the region of about 50K. But you want to be using an automated issuance platform for a security token offering because of the accredited investor verification requirement. And also, some of the issuance platforms are hooked up to ATSs, so it offers a smoother process.
And the accredited investor point gets also to sort of larger KYC issues that are present here. You know, broker dealers and other financial intermediaries have AML KYC requirements as a result of the Bank Secrecy Act and the regulations from FinCEN under the Department of the Treasury. All of that has been the subject of a lot of discussion and debate over the last bunch of years. FinCEN was actually one of the first US regulators to give an interpretation on what they called convertible virtual currencies and what some of the requirements were for money services businesses or money transmitters in connection with that. Those issues of it's not so much accredited investor as it is just know your customer standards in the AML world. That's becoming a much more pronounced issue in the US, in part because of the proposed rules that came out before the end of last year, right before the Trump administration left and the Biden administration came in. It's also become more pronounced on a global basis because of the proposed guidance from Satis that came out in March of this year. Both that Treasury FinCEN proposed rulemaking and the Satis guidance were the subject of a huge amount of commentary by people in the space. I don't think anybody's arguing that broker-dealers and other financial intermediaries who engage in transactions with tokenized financial instruments have obligations, but a lot of the obligations were expanded in ways that are unique to the blockchain space. And so people, I think, saw that as a big problem. There's also, with both the FinCEN and the FATF, there's also issues just around financial privacy or privacy overall. Part of the proposals under both of them would have had, and the FATF stuff is still uncertain where it's going to end out, but under Treasury would have had both counterparties to a transaction fully identified, including their public key addresses. And so, of course, once you know the public key associated with an account on most of the public blockchains, you can see all of the transactions in and out of that account. And obviously, you know, if the rule says you have to report to the government any transactions over $10,000, but in the course of making that reporting, you divulge the public key and you divulge the public key of both parties to the transaction, and you can see literally everything that's happening in those accounts. And so for financial privacy and other reasons, I think there was a lot of people talking and submitting comments around those issues. I know in Europe, under the GDPR, there's also limitations, although typically those limitations don't apply in response to requests for information from the government. So I think there's some work that needs to be done there to understand the exact implications under GDPR of the proposed FATF guidance. These issues are just like all of the other issues around here, around the blockchain space. They sort of seem to be creating novel issues. And the novel issues, to my mind, stem a little bit from, you know, is it a security or not? Is it a financial instrument or not? But the larger point here is that, you know, once you have an ERC20 token, regardless of what that ERC20 token is, it can trade on any compatible platform. So if the ERC20 token represents a pair of Air Jordans, or if the ERC20 token represents a share of Apple stock, or if the ERC20 token is just Ether, for example, all of those things trade on DeFi platforms, and the DeFi platforms are not making distinctions of, oh, we have to trade the securities over there and the commodity futures and synthetics over there, et cetera, et cetera. It's just allowing all of these different kinds of tokens to interact with each other in marketplaces. I think that issue is not one that's been well thought through or well understood at this point, and contributes to, I think, some of the uncertainty around what the regulation should be, and maybe the overbreadth of the regulation. I don't know, Emma, if you want to comment on that a little bit.
Yeah, I think DeFi is going to see a lot of regulatory action, just by the very nature of the fact that there's rules about these things. You know, something that's a share has to trade on an ATS and be subject to, you know, complex requirements. The SEC and FINRA impose on ATS broker-dealers, and you can't just say, hey, we're DeFi, we don't count. So I think that's going to get quite messy.
Yeah. So what do you think what do you think the chances are that there's going to be any regulation around DeFi before there's regulation just more generally around sort of centralized intermediaries, as opposed to a sort of quote unquote intermediary that's just some computer program or smart contract on the blockchain?
I think we'll see regulation by enforcement, as we have with tokens so far. So I'm not sure we're actually going to see regulation. I think we'll see a series of enforcements.
Yeah, and it's kind of unfortunate that we're going to be stuck in the world of enforcement as opposed to in the world of you know, easy to understand, easy to apply regulations for a while.
I don't think we've got easy to apply regulations anywhere, at least not in US securities law.
Yeah, I think that is unfortunately true. Do you want to walk people through the developments in SDO offerings?
Sure. Probably the most important was the 2018 test of JP Morgan's Quorum, issuing and trading a 100 million Yankee bond. Quorum is now a joint venture with Consensus, and continues to be sort of the best in class for private chain technology for security tokens. Next up was the World Bank's $81 million bondy, a second issuance a year later at 33.8 million. In September 2019, Santander announced the issuance of a 20 million tokenized bond. It was controversial because it was the first large issuance transacted entirely on the public Ethereum network. And between gas fees and security issues, generally speaking, people think that private Ethereum is a better version for security tokens. 2020 saw both Denver and Berkeley seek requests for proposals for mini municipal bonds. That's bringing the denomination down from $100,000 to $100, but neither of those have actually gone forward. 2020 was a busy year. April saw the DCCC release a project called Project Whitney case study, which is a blockchain-based prototype on the Ethereum network for DCCC. Nasdaq then announced its new marketplace services platform for digital assets, which is in its still early stages, but has the possibility of being very powerful. In July, Liquidity Edge and R3 announced a plan to digitize the corporate bond market with a new trading platform, Ledger Edge. And then in September, the Singapore Exchange announced it completed its first digital bond issuance working with HSBC and Temasek, launching a 400 million 5.5-year public bond. utilizing the DAML smart contract language created by Digital Asset.
So with all these platforms coming online, it sort of seems like there will be security tokens that start to trade eventually. Under Regulation S here in the United States, offerings that are effectively offshore, that is, say, non-US offerings, are exempt from the US securities laws. And so when we see countries like Singapore, I think the Swiss exchange is also trying to move into this space. When we see those kinds of platforms cropping up, it'll be interesting to see how many token issuances get done outside the US under Regulation S. But they still have to deal with the flowback issues of the tokens flowing into the US. I don't know how people sort of expect to handle that issue. Have you given that any thought, Emma?
You can code into the smart contract a restriction on US holders, so you can stop the transaction in the wallet rather than sort of try and pull it back.
And so that would be some kind of a whitelisting process with the wallets, or how would you do that?
It's just an information requirement of when the token's being sold, the nationality of who it's being sold to, and if nationality is US, then it just stops in the wallet and doesn't transact.
I see. And so is that like some kind of a digital identity kind of thing, or how does that work?
It's more an information requirement and a sort of trading protocol.
Got it. Okay. Yeah, these questions are going to get tougher. One of the things that I think a lot of the technologists early on in the blockchain space either didn't realize or realized and didn't really care about was the fact that blockchain transcends national borders. And so, when you have different rules and regulations in different countries or jurisdictions to deal with, it can create all kinds of headaches. Now, presumably the technology can solve those headaches in a variety of ways, but the blockchains were definitely not designed to solve those problems. The blockchains were designed to just function on the internet, which is this completely open place that exists because lots of computers are linked together and doesn't really know or respect jurisdictional limitations or jurisdictional requirements. So anyway, tough to figure out how all of this is going to play out over time. Do you see, Emma, regulators sort of coming together and analyzing across jurisdictions?
No. I think it would be a nice idea, but I just don't think that's how regulators' minds work, that they do their jurisdiction and unifying legislation is just not something we see other than within the EU.
Yep. So I think we only have about 5 minutes left. And so folks in the chat, please throw some questions at us. Hopefully we've given you sort of a decent overview of what the situation looks like in the US. Let's see. Oh, the Q&A. Sorry about that, Richard. I was not looking in the Q&A. I was looking in the chat. Yeah, so I mean, this is incredibly difficult, right? So on the one hand, you've got sort of FATF, which sets guidance for more or less financial intermediaries with regard to AML and KYC requirements. And that sort of seems to be as close as we're getting in this space to some kind of equivalence for operating globally. But the nuance around whether something is a regulated financial instrument, and if so, how it has to change. If something is not a regulated financial instrument, how does the trading of that work? With the privacy issues, the differences in privacy on a whole bunch of levels. These questions, and there's plenty of others, so those are sort of just the big ones off the top of my head. Oh, and I shouldn't forget taxation, figuring out how different transactions are taxed. Some countries have stamp duty taxes for different types of financial instruments and whatnot. So there's all kinds of issues associated with this that are very country specific. And as Emma points out, it's hard to see how there's going to be a coming together amongst regulators, to create something that would allow for the operation of a platform globally. Throw a huge caveat, that you can drive a truck through here, which is, and then there's DeFi, right? And so sort of there are versions of DeFi where what is, I think, truly happening is just some code that sits on the Ethereum blockchain or some other blockchain and allows people to execute transactions or make and receive loans or whatever. It's hard to see how that is regulated. It's also hard to see how that's going to stay unregulated. So I think there's a whole host of issues presented with DeFi that we touched on a little bit earlier in the conversation. I don't know, Emma, if you want to add anything to that.
No, other than enforcement is coming. Enforcement is definitely coming.
Yeah.
All right.
Okay. Well, if there's not any other questions, thank you all very much for your time. Hopefully the deck is helpful. And feel free to reach out to Emma and I on LinkedIn. We occasionally post stuff. Emma and I are both part of a group called Global Blockchain Convergence. We just posted on our LinkedIn page a token classification system that tries to deal with some of these issues at a high level and really push the debate. So we encourage all of you to check out the Global Blockchain Convergence LinkedIn page. Read, we've actually done a bunch of things over the last several months. So please read up, reach out. We'd love to continue the discussion with all of you.